Hello and welcome to M&A Murders and Accusations, the good, the bad, and the ugly of selling your business. We dig into what you need to know and how not to kill the sell of your business. Now here's our host, Rick J. Krebs, Mergers and Acquisitions Advisor.
Hello, everyone, and welcome to M&A Murders and Accusations. So I'm excited today. We have Jacqueline Martinezof from Alaris, and she is also a sell-side advisor. You might be saying, Rick, why are you interviewing another sell-side advisor? Well, she has a specialty. We're going to talk about that. But welcome, Jacqueline. We're glad to have you here today.
Thanks so much, Rick. I'm really excited to be here too. It's always nice to connect with peer. We understand each other, the language, and excited to do this today.
Yep. And we're going to commiserate a little bit about what we see out there. But I think getting a group of experts together is a good thing. And but we don't really directly compete, but we are in kind of the same space. So I'm excited to hear from you and your knowledge that you're going to share with us today. So first thing, I always ask listeners and participants to share a little bit about themselves. So tell us a little bit about yourself and how you got into selling businesses.
For sure. So I live out in Orange County, California. I have lived here with my family and 2 young children. So always keeping me on my toes and my negotiation tactics sharp, as you can imagine. Prior to being part of Alaris, which I've been doing this for 3 years now, I worked for a large registered investment advisor, RIA, for about 8 years. Prior to the sale of it to Goldman Sachs in 2019. I stayed on for a couple of years at Goldman and reworked our M&A program, and then ultimately decided to join my now business partner, Alan Darby. And we work with about 60 of the top RIAs in the wealth management space. So we're very focused on RIAs or hybrids, some insurance work, a little bit of tax, but mostly wealth management, working with the major players in the space. And we're coming up on our 50th transaction here at Alaris. So been very thankful for so much activity and referrals, and just keep it going. It's really been working well.
Great. Yeah. Sounds like you have a lot of experience and done a lot of these 50. I mean, that's 50
as Alaris, and then back at United Capital about 30, 35 that we did during that time. So I was in-house M&A for an RIA buyer. And so it's nice, working with sell-side advisors, not really loving the process either. And so when decided to form Alaris, I was and continue to be very thoughtful about the things about working in those processes as a buyer, how frustrating it can be, and trying to think about things differently and make it more efficient for both sides to get through the process, get to know each other faster. And that's really informed our business model that we run today.
Mm-hmm. Well, good. Very good. It sounds like we've done about the same amount of transactions. I haven't kept count, but I'm probably 85 to 100.
That's awesome. So,
yeah. So tell us something, before we get into it, tell us something cool about yourself that most people wouldn't know. It sounds like you're a mom. That's really cool. But tell us something.
I'm a mom. Yep. It's always such a tough question, but we recently got back from Costa Rica, a nice family trip down there. And I realized I totally love riding ATVs. We did a little activity. My daughter was riding on the back. It had just rained. There was muddy puddles everywhere, and monkeys howling in the trees, and she was just screaming to go faster, and she was so brave, and we just had the best time. So now I'm trying to think, okay, where can we do ATVs next? Because it was just so much fun. So it's nice. I love, it's like the world we live in now. You're always taking photos, and I love those days where you don't take a single photo. You're just totally in the moment, and creating those memories with the kids is awesome. Yeah.
Oh, that's really neat. Good for you.
Yeah.
All right. So let's get into the business side. Tell us, what do you do specifically?
What do I do specifically? So we we have two sides. Our business model is a little different, I would say, than most of our competitors in the space. We spend, I would say, an equal amount of time across our whole team getting to know all of the buyers that we have on our roster. So the 60 or 65, I lose track. We are doing interviews. We are doing a full diagnostic on how life looks like for sellers once they join, and all of the operational areas around, like in the wealth management space, it's, trading and reporting lines for your team and issuing equity and, just all of the compensation plans and all of the operational nitty-gritty, some things that touch clients and the back office things too. So we're really getting in depth with our buyers to understand what their offering looks like. And then that way, the sellers, if you will, as they're coming through our process and they're articulating to us, we run a very similar diagnostic with them to understand, okay, what elements are you willing to give up control over in a partnership? What things do you want to retain control over? And we're doing a lot of education around managing their expectations on things that they may not be able to do after the closing or not. And so when we get to the point where we're making introductions to buyers, they're very informed of the trade-offs that may happen with really wanting to, for example, retain control over all investment decisions and do the actual trading, for example, or that's just an example, but any given item. And we find that really speeds up the get to know you process with all the education that we do.
Gotcha. And is there a particular industry that you specialize in?
Yes. So we mostly work with independent RIAs.
Okay.
I would say between like 250 million to 2 billion. But also work with hybrids as well when they're affiliated with a broker dealer. We do a lot of that as well.
Gotcha. So AUMs or assets under management between 150 million. Mm-hmm. And what was the top end again?
I would say 2 billion would be, most of our activity is kind of in that 500 million to 1.5.
Gotcha. So you specialize in RIAs. For those people who don't know that are listening to this, that's registered investment advisors, right? Basically, used to call them stockbrokers, but it isn't that anymore. They manage wealth, they manage money, and they help people with their personal financial plans.
Absolutely.
Yep. I also work with RIAs, but I haven't sold any. So that's one of the reasons why we wanted you on, Jacqueline.
That's awesome. Yeah.
So 150 million minimum. And most of yours, I would say, what is your sweet spot deal size? Our
sweet spot, I would say, like when you think about all the RIAs in the space period, they're really concentrated in that 500 million to $1 billion place. So our average tends to kind of follow the opportunity set and be in that range too. It's a nice, I find that RAs get to an inflection point as they approach $1 billion in assets where they're weighing, growth plans that they want to achieve, but understanding that the current team may not be enough to get there. So they're weighing, do we add additional resources? Do we add more advisors? And develop training programs, develop ways to bring along the next generation of advisor to be up to that founder's level of being able to do business development and all of that. And oftentimes founders they're great at being advisors, but they may not be great at training. But if that's where they want to take the direction of the firm, partnering with a larger firm that has a well-identified way to groom, to train the advisors, is the way to get there. And a lot of, I would say 90% of the advisors that we work with, they're not looking to exit the business in the next few years. They're looking to change the way they work. They're looking to offload the back office, HR, accounting, all of those things that take up a lot of their time but aren't generating revenue. Looking to offload those, have more scale, have a way to train advisors, and partnering with a larger firm really solves for those things. In addition, of course, to solving for their personal planning and succession and de-risking their asset, have a liquidity event.
Gotcha. That makes sense.
Yeah.
And so I was intrigued by what you said about culture and how you differentiate yourself from your competitors based on culture. So talk to me about that.
Yeah. Culture. I mean, how often are we hearing cultural fit is the most important thing from buyers or sellers?
Mm-hmm.
Like, does that come up on a regular basis for you?
It doesn't.
No?
My sellers will talk about it a little bit, but I don't think they realize it. So
Yeah.
initial discussions, maybe not so much, but my what I find is as we get deeper into it, we start looking at it, then it's revealed. I want to say a cultural reveal. They're just like, oh, wow, I do care about my employees. I do care about, this is my baby. And they start to get very emotional as they think about selling it. Oh. And when that emotion comes into play, then they're like, wow, it is about culture. It is about a fit. It's, I always say the right buyer for the right price. And if you have one or the other, but not both, you don't have a fit. You don't have a transaction, right? It's not going to work. So yeah, I would say culture is something a little bit under the surface, but you scratch a little deeper, then it comes up in the conversations. And then they realize just how important it is.
Definitely. The sometimes we'll say like culture is code for cash. Of course the price, it matters a lot. It's oftentimes their only business that they will ever sell in their lives. And you want to get that right. You want to walk away feeling confident in your decision that you got a fair price, that it's the right match. I would say where Alaris differentiates itself is that time that we're spending with the buyers to really understand what types of autonomy will the advisors have after the close on a variety of elements, and spending equal amount of time with the sellers to understand what things are they happy to get rid of and what things are they not, where are they really looking to have extra resources, and find out what really matters to them and matching them with a buyer that really excels in that area. I think, out of our going on 50 deals that we've done, happy buyers, happy sellers, because there's so much information sharing in that exploration part where, of course, we're working on the deal and the negotiation and all of that stuff, but we also have the seller's entire team matched up with that respective person on the buyer side to really get into the weeds of, okay, what about my job will change today? There's no reason to be nervous about my job going away. Like, it's such a war for talent in the wealth management space. So the fear of being let go is so rare that happens. Because yes, some responsibilities may come off of your plate, but oftentimes, especially in firms where you're managing 500 million, people are wearing tons of hats. They're probably happy to give up the compliance hat and spend more time on other things. And it's about, having more resources behind you, being able to, for each employee on the team to look at that and say, wow, okay, if I didn't have to do that anymore, I would really love to do more business development, more marketing, fill in the blank, and creating that career path that wouldn't be available to them if they stay as their own independent firm. So that exploration that we're doing with both sides, it also culminates in when it's time for the buyers to present their offers, that they have high confidence. Okay, this group really would be a great fit for us. They're putting their best foot forward on that first offer, rather than like when I was in the buyer's seat, working with sell-side advisors, we would have round after round where I felt like I was bidding against myself. I wasn't even that confident that this would be a great addition, accretive to our business. I didn't know enough. A lot of question marks, and just sending in bids, and hearing the disappointment from the sell-side advisor about the bid, and it was just not the way that Alaris operates. We give a lot of access so that both sides can really determine, this really does feel like a great fit and makes the negotiation process of the deal go smoother, we find.
Gotcha. You said a cultural auction process. You brought that. I love that phrase.
Cultural competition, if you will. All of the buyers we work with, they're super active. They know what market levels are for a given business at each EBITDA range, at each EBITDA level, rather. There's kind of multiples that are reasonable, and what makes a firm command an EBITDA multiple at the top end of the range for that given size is pretty consistent on what will drive that or what won't. So we're doing a lot of education around that, and so sellers come in really with a good picture of what to expect and kind of remove that from the conversation. We try to encourage not talking about offers for a little bit so that it can be all about that cultural competition and kind of dissecting the elements of the integration and ongoing to make sure that life will be what they think they want on the other side of it. And that's what we mean by that. That makes sense. Yeah.
Tell me, what are cultural things that you see are favorable to a seller? What are things that they like to see from a buyer as far as culture is concerned?
I find them there's so many, but my mind goes to the elements of the partnership that are closest to the end client relationship. So in our industry, financial advisors, they have their end clients that they work with. Mm-hmm. They likely have worked with them for many, many years, and they don't want to disrupt the status quo. They want to be able to add in new things and potentially offer those to new clients, but anything that impacts how investing has been done in the past or how the financial planning process works, they're nervous to disrupt the apple cart, especially when, in most of the transactions we work on, 100% of the purchase price isn't paid at the close. There's some portion that's held back, dependent on client and revenue retention. So anything that goes to changing client fees, adoption of a centralized investment management offering, dramatically changing how the planning process might work, all of that, those elements, if there's a lot of change that's required in the beginning, that can be a challenging thing to work with, to make that work.
Yep. You lose clients too, right?
You could.
You're going to lose your clients, and that's what they're buying is the client.
Yeah, right. And so, I found even with the national buyers that have, a lot of scale, a lot of processes defined, it's an offering, it's there if you want it, but they're making a big investment. It makes zero business sense to disrupt that, unless there's something from a compliance perspective that is not workable. From a business perspective, they're not wanting to change a lot. And so I think teasing out what really is required, what is, there for us if we need it. And, I would say too, most of the founders of wealth management firms, they're entrepreneurs at heart. So the idea of, needing to get approval for time off and, spend time at their house in Florida or whatever it is, a lot of those are myths, and there really isn't that type of, oversight on time and all of that. But I think asking those questions and just understanding what life will be like, speaking with advisors that have been at the firm for a little while, is also a really important step too.
Gotcha.
Yeah.
So let's move to the financial metrics.
Sure.
What are the key value drivers?
So the big one I would say over the last few years is net new assets or organic growth.
Gotcha.
And
not just assets.
Not just yeah. And exactly. So kind of taking, okay, if overall my assets grew, just making up numbers, 10%, mm-hmm. but the market did 8% of that, kind of set the market to the side, which is so interesting, right? Because they're in the business of managing money, and shouldn't the assets perform similar to the market? And if it is wildly off, then that would raise questions too. But usually really just setting that 8% aside. And now we're looking at the 2%. So your new clients that you're adding, clients that are lost, or, maybe they passed away, whatever it might mean, and really isolating that organic growth, all the growth excluding the market. Mm-hmm. That's what's focused on. And it's a new concept for advisors. I think with private equity entering the space and backing a lot of the national and regional buyers in the wealth management space, that they brought that term to the industry. And so but it's not intuitive to advisors. So it's another area of education where we're helping kind of dissect that and have that number ready. And if it's not at least at, call it 4 or 5%, then you run it becomes a big factor in what EBITDA multiple will be placed on the business. Buyers, in order, the multiples that these deals are going at, it's an important value driver for the overall returns to work for the buyer. And so if we don't have a healthy baseline of organic growth that the buyer can help build upon through their organic growth channels, it's hard to make the higher multiples work.
Gotcha. And what's the range of multiples, low end and high end, you see?
It varies by the size of firms, but of course, but I would say for it's kind of all over. It's kind of a tough question, but maybe for a $500 million shop, kind of run of the mill, 30% profit margin, 30 to 40%, something like that. Mostly based on EBITDA is what our valuations are based on in this space. Could be from, 9 to 11 times that EBITDA level there. And then not all paid at the close and, spread out over time based on the risk profile.
It's kind of a ballpark. I was just curious.
Yeah.
No, thank you so much, Jacqueline. It's been a pleasure to listen to you and to have you share your knowledge and wisdom and experience with us today. Hearing about cultural auctions. I never learned that term before, or heard that term or that phrase before you brought it up. So thank you.
Feel free to adopt it. Yeah.
Well, I appreciate that. Thank you.
Yeah.
And thanks to our listeners today. This is Rick J. Krebs, the M&A Cowboy, coming to you from Heber City, Utah. M&A, murders and accusations. We're going to call it the good today. This is the good part about selling a business, and you've been very helpful and informative today. Thank you, Jacqueline.
Thanks so much, Rick. Have a good one.
Thank you for attending our podcast. We invite you to join us for future episodes of M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. You can also visit us at www.bsalesgroup.com or email Rick directly at rick@bsalesgroup.com.